Here's a financial blind spot I see all the time, and it's quietly costing couples thousands of dollars a year. One spouse earns significantly more, so the other gets overlooked when it comes to saving strategy. That means missed tax advantages, underused accounts, and inefficient planning that bleeds money. And the worst part? It's completely avoidable. Hi, I'm David Caviness, certified financial planner. In this video, we're going to talk about how couples are leaving money on the table simply because they're not planning together. Let me paint the picture. One spouse has the big paycheck. Maybe they're an executive, an entrepreneur, just a high-earning professional. The other, maybe they're managing the household or working part-time, or simply earning less due to their industry. So what happens? The lower-earning spouse doesn't max out their 401k, or contribute to an HSA, or participate in their employee stock purchase plan. And here's the key insight. When your finances are shared, your financial planning should be shared too. When you're married, every financial decision should be evaluated as a team. It's not about who earns more, it's about what strategies are available to the household. So if your spouse has access to a 401k with the match, and you're not contributing enough to get it because you don't feel your income is high enough, that's a household level miss. Same with HSA, same with backdoor Roths, and same with equity plans. Every dollar of tax efficiency, every retirement contribution, every employer match. Don't look at it as theirs or yours, consider it ours, because you are both part of the same long-term plan. So here are 4 common opportunities that often go unused. 1, your 401k. Even if one spouse earns less, they still may have access to a 401k and possibly a match. Not using it leaves both free money and tax savings on the table. Health savings accounts. If you're enrolled in a high deductible health plan, you can contribute pre-tax dollars to an HSA. And these accounts are triple tax advantaged and often ignored by the lower income spouse. And the employee stock purchase plan. If available, this is a powerful way to buy company stock at a discount. Done right, it can be a wealth building strategy, but many lower income spouses skip it because they don't feel they have extra money. And lastly, the backdoor Roth. This is a huge opportunity to add tax-free retirement dollars, especially in high-income households, but I've seen countless situations where only one spouse is doing it. So why does this happen naturally? Sometimes it's emotional. I don't want to use your money to fund my retirement. And other times it's just lack of awareness. I didn't know I should be doing that. But in either case, the result is the same. Inefficiency, missed opportunities, higher taxes, slower progress toward your shared goals. So let me say this clearly. If you're filing taxes jointly, you're already viewed as one unit by the IRS. You might as well plan like one unit. Even if you maintain separate accounts, you can still adopt a unified strategy. You're building one future. Make sure your savings and investment decisions reflect that. So let me give you a real-world example. A couple I work with, let's call them Alex and Jamie. Alex is a tech executive earning $400,000 a year, and Jamie is a teacher making $65,000. Jamie didn't think her contributions mattered, so they weren't funding her 403b. They skipped the HSA, and there were no Roth contributions either. When we looked at the full picture, we realized Jamie could add over $30,000 per year in tax advantage savings, all while staying within their joint cash flow plan. Alex and Jamie had the margin, they just hadn't viewed it as a joint opportunity. So fast forward a few years, and that shift has made a huge difference. More tax-deferred growth, more flexibility, more alignment. Because it's not just about the math. When both spouses are financially involved, something shifts. You stop operating in silos. You start working toward the same finish line together. There's more clarity, more engagement, and ultimately more success. It's not about control, it's about collaboration. You don't have to merge every account or combine every dollar, but you do need a shared plan that considers everything at your disposal. So what should you do now? You need to review all benefits and accounts for both spouses. Look for those missed opportunities. Calculate your tax efficiency as a household, not as individuals. And fund the accounts that best serve your long-term goals, even if one spouse needs help doing it. But most importantly, talk about the future you want and make sure your financial behavior supports it together. Let's stop leaving money on the table. Let's stop letting emotions get in the way of smart planning. Again, I'm David Caviness, Certified Financial Planner, founder of Caviness Wealth Management. If you're ready to make sure your financial life is optimized as a team, join my newsletter at CavennessWealth.com. I share tips like this every week, designed for high-achieving families who want to be more intentional with their money. And if this video helped, like and subscribe so you don't miss the next one, because your money should reflect your life, not just your paycheck.